exposing the synthetic silver scam. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
So we're continuing our ramble through silver.
So today I want to actually go into a very interesting aspect of silver, and there's a category of products that are available around the world that I have written about over the last sort of year or so, and I've got some concerns about. When we've talked about mortgages, when we've talked about sort of other things where we thought we had concerns about certain products and the risks that our general audience, our general Australian audience wasn't aware of, we'd try to bring some attention to that. So there is a category of products in the gold and silver market that I know some of our viewers have exposure to, and they definitely don't know the full extent of the risks of these products, because as I've been speaking with my other hat on to a range of Australians about some of these what I call synthetic silver products, what I have found is people are not particularly clear as to, well, what have they invested in, what are the risk profile, what happens when something can go wrong, etc. So today's conversation is really to not push any particular barrow or anything like that. It is really just to highlight that, consistent with our previous commentary, here's a new financial product that we want to sort of we want to explore and actually explain the ins and outs of that product, and what are the benefits, what are the risks, and obviously allow people to decide what they do because of our analysis.
Yeah, and just to be clear, John, at one end of the spectrum you've got solid silver, right, which you own and can feel and hold, right?
Yes.
And then you've got essentially a bunch of let's call them derivatives or flexible products, which effectively are providing access to silver, but not necessarily completely directly.
Exactly.
Just like many other markets, as we've discussed, the one-to-many variables and relationships between underlying and all of the other structures that are across financial markets. So this is not unique to silver, but we're going to focus in particularly on silver because you have the same example of fuzziness as you move further away from the physical.
So I've got three basic definitions here. So first one is physical. When I refer to physical, it means a physical gold or silver product which the investor possesses legal title and ownership and has in their possession. Allocated means a gold or silver product which the investor possesses legal title and ownership, but is stored in a third-party storage facility segregated under a legal identity. And synthetic means an investor has supposed exposure to the benefits of gold and silver, but does not have legal title and ownership. Now, so we have a bar of silver here, Martin, so we'll just hold this up to the camera. So this is a kilo of silver. Now, this is something I have purchased, and I have this in my possession. So under my definitions, so that is what I would call physical, because it is because I have it and it's legally mine because I purchased it. Now, if you had a vault here at your house or here in your studio, and you said to me, John, by paying a storage fee, I will have safe custody of it. Well, it's still legally my property, but I would call that allocated because it's allocated into your custodian or your custodian sort of storage facility. Now, where we get into this interesting issue of synthetic is that you invest money in a product where there is no legal title. So you do not actually own any specific bar or specific coin, but you effectively have purchased a share. So in terms of some of these products, so let's just go through them. So we have typically what they refer to as unallocated or pool allocated. So typically those entities that provide these products, effectively what they're saying is that they have a pile of gold, a pile of silver, and rather than actually buying a specific bar or coin, you are buying a share of that, and basically you enjoy the benefit of the price exposure. So what happens in that situation is that if, for example, if you had $100,000 and you wanted to buy 100 kilos of synthetic silver, if the price goes up or down, you have the ability to cash your position in, and they will give you back Australian dollars, for example, consistent with a change in price. If you ever wanted to convert your synthetic position into a real tangible bar position, then you pay a fee, and then you hope that the silver or the gold that they come up with it and they actually give it to you. But the important aspect of this is that with these products that you unallocated, pull allocated, and then with the ETFs. Now, ETFs is a specific legal structure, so it is a trust. When you buy an ETF, what you are technically buying is you're buying the unit of a trust, and that unit basically means you have a share of a legal entity, but you don't actually have any direct ownership of the underlying assets of that trust, and ETFs are used for all sorts of commodities and in terms of financial markets, etc. But when it comes to ETFs of gold and silver, if you invest in an ETF, the assumption is that as the value of the underlying asset goes up and down, the value of the ETF will go up and down, and that's how you enjoy the benefit. But you technically do not own anything of any gold or silver or whatever it may be in the trust. You technically just own the trust. So if you buy a unit of a trust and there is technically nothing in that trust, well, technically you don't own anything other than this share of a trust that has nothing.
Right. And we should be clear, John, this is separate from the concept of a futures contract for futures delivery or an options to get a futures contract. This is effectively much more to do with the physical silver and its relationship to the right that you have against it.
Yes. So we're not talking about futures trading.
Yep.
We're talking about products that are offered in the retail market.
Yep.
And these are products offered right around the world.
Yep. Okay. And I wonder how many people, when they actually go buy their ETF or whatever, actually ask the question about how far am I away from the real silver?
Yes. So when I have had conversations about these sort of products, and people have put money in these unallocated, pull allocated, or ETFs, I always ask the question, well, what do you think you own? And generally, people are a little bit unclear that they actually own anything. And so now, one of the reasons why they typically want to buy one of these products is that one is because they are lured in by cheap fees, so transaction costs are much lower. You don't have to pay storage in terms of some cases, and so obviously you don't actually have to handle the gold or silver. So the risk of losing the gold or silver, if you have it in your physical possession, you don't, because someone else is holding that for you. So they're the typical reasons why people can do it. And obviously, when it comes to selling or buying, because it's on an online platform, it can be very quick, just a click of a mouse. So they're the typical benefits. But when I have the conversation, so well, what do you own? But also, more importantly, what are the risks that you have been, what are those risks with these products? What I have tended to find is the understanding particularly among Australians, is that they really haven't delved into what's the risk profile. And again, so touch wood, so far, since I've been in sort of playing in this space for the last few years, nothing in the Australian market has gone wrong. But obviously, it's kind of like when we're talking about bail-in. In general economic conditions, like a bail-in of a bank deposit won't happen. It's when you have that moment of crisis where the question is, well, will these investments or will these products stand to scrutiny, or will they sort of fall like a tower with standing on sand?
Right. And in the case when you don't have physical, right, presumably you've either got some sort of IOU or promissory note or something, or an electronic record somewhere that shows that you've got access to it, right? And that's all you've got.
Correct. Correct.
So John, you've got physical, you've got allocated, you've got synthetic, right? In the case of allocated and synthetic, right, how do we know that there is silver standing behind that transaction? In other words, is it 100% backed in silver?
Those who provide the synthetic products to the market, part of what they say is that that these products are 100% backed. So if you've got $100 million worth in these products, they have $100 million worth of gold or silver standing, that they have it physically in their possession in one form or another. There's also claims of that these holdings are audited and that they are checked, and there are nothing done to these holdings. For example, they're not leased out, that they're not traded on or anything like that. So they're the sort of claims, and they're sort of assurances that like a whole host of entities provide to investors to say, well, how do you trust that this product is real and that you're not going to be screwed over? They're the sort of claims that people make. But what we're going to talk about next is in terms of, well, what are the risks?
Okay, and presumably just like any other asset class and market, there's a lot of different risks, types of risks.
So I just want to, for the audience sake, is to go through the difference between what I define as market risk versus counterparty risk. So market risk is the risk of losses in positions arising from movements in market prices. Counterparty risk, also known as a default risk or counterparty credit risk, is a risk that a counterparty will not pay as obliged on a bond, derivative, or insurance policy or other contract. And no doubt in your career, Martin, I'm sure you've seen multiple examples of counterparty risk actually coming to fruition.
Well, of course, a lot of the derivatives markets around the world, and can go beyond that, are all about trying to assess risk and trying to manage risk and trying to measure it. And it's all about counterparty risk of various sorts and sizes, right? Because what you want to try and do is to mitigate any downside, but also capitalize on upside, right? And that's what traders do all the time.
If you own a bar of silver like this, you are exposed to market risk because the price of this can go up and it can go down. And obviously, if it goes up, you benefit. If it goes down, then you actually experience losses. But with this, there is no counterparty risk because it's my property and it is in my possession. Now, where counterparty risk comes into fruition in the context of gold and silver is that, so for example, if I had that, now there's two types of counterparty risk. Now, with a bar of silver that I own, if I was to store it here at your facility, that's a form of counterparty risk because even though it's my legal title, if I ever want to retrieve it, there's a trust that in your vault you're going to sort of produce it and it's all going to be fine. But then when it comes to these synthetic products, is the counterparty risk is that one, if I wanted my theoretical share of this pile of gold or silver, if I wanted to convert it, that they actually have the gold or silver to convert when I want it. And so timing is obviously critical. And then obviously the other point is that if I ever wanted to cash out my position, because I don't actually technically legally own anything of a tangible nature, that the counterparty has sufficient funds to provide the money, or so that I can get my money and I have to say, so you get your money at the price in which the market prevails. So, for example, if you buy something at say $5. And the price was to escalate to $100, well, obviously you would expect that if you cash out your synthetic position, you'd be paid out at the $100 price.
And I guess the counterparty risk has to take account of the possibility of it's not just you wanting to, for example, convert to silver. It could be that everybody on the same day, theoretically, might want to convert to silver.
Yes, and look, I'm glad you mentioned that, Martin, because it's no different from a bank.
Yeah.
So I mean, when you think about the banking system, we have a fractional reserve banking system. So so the bank will have a certain number of assets and they'll have deposits on hand of a certain percentage. So while there is a small amount of deposits being asked for, the banking system works fine. If everyone was to walk into the bank today and say, I want my money, well, then you have a bank run and they don't have all the money there. And so that's when you have capital controls and they say, well, you can't have your money. So again, now, the proponents of these products say it's 100% backed, and if it's 100% backed, there should be no run. And even if everyone was to ask for their metal today, they should be able to get it in theory. Now, if there was some reason that it wasn't 100% backed, and you did ask for it, and there was a lot of pressure for it, well, then obviously those sort of elements do get exposed. And while I'm not aware of any Australian examples of that, I mean, there definitely have been international examples of claims of backing and then when you stand for delivery, those things actually haven't come to fruition.
Well, how do you know if you're an investor in one of these things and it says 100% backed, right? You take their word for it, but how do you validate it?
Well, so those who provide these products, their assurance to the market is that the backing is audited by someone independent, and the auditor's opinion, that is what you rely on to say, right. I'm confident. Now, where this comes into some very interesting conversation is that we talked about the Perth Mint in a show last year about some of their backing and what constitutes backing. Now, we did a show, so we've been talking about the Reserve Bank of Australia and gold leasing. Now, what we revealed over the last few years was the RBA has leased 11 tons of gold, and we were scratching our heads thinking, well, who has that gold? Then we found out from the RBA testifying to the federal parliament that their claim was, well, when we lease, the gold physically does not move. And I'm thinking to myself, well, why would you lend gold? So, we know why the RBA says they're lending the gold because they want some fees for lending. But I thought to myself, why would someone borrow gold if it physically does not move? So initially I thought, well, that can't be right. The gold has to move. And then what we found through an FOI process that we talked about last year was the person who's been borrowing the 11 tons of gold has been the Perth Mint. Yeah. Now, what we discussed in our show on that occasion, which was August of 2020, was, well, why would the Perth Mint borrow gold that physically does not move? Now, because what is the Perth Mint's business? They are basically a refiner and they're a retailer. So they produce product and they sell it. So why would they need to borrow gold that technically doesn't move? And the reason that we discussed on that occasion was because they have synthetic positions. So they have unallocated, they have pool allocated, they have ETFs, the Perth Mint has an ETF, and so when the auditor walks in and says, okay, show me the backing of these products, well, what we discussed on that occasion is that not all that backing is gold or silver physically in their possession. It's actually, they've actually borrowed gold or silver that ticks the boxes for the auditor on a balance sheet. But if everyone was to stand for delivery at the Perth Mint, there is some physical metal that's missing because it's technically over in the Bank of England. Now, what we revealed last year, Martin, in our show was, so this was based, so the Perth Mint's corporate name is Gold Corporation, and what we revealed was that as of 30 June 2019, the physical, the amount that they had borrowed in terms of gold or silver leasing was, and we'll put this on the screen, was $1.226 billion. Now, of that amount, roughly about 700 million was the 11 tons of gold, and what we didn't know was the remaining almost half a billion. What constitutes that? Is that gold? Is that silver? We don't know. Now, in preparing for this show, I actually looked up the most recent annual report, and as of 30 June 2020, the amount that is what they call precious metal borrowing interest bearing. So the interest bearing is effectively what you pay in terms of the lease agreement. It's up to now $1.721 billion. So they've actually borrowed more in the last 12 months compared to when we did our show in terms of last year. So now, again, a portion of that 1.7 billion is the RBA's 11 tons of gold, but it looks like they have borrowed more gold or more silver to back up their synthetic positions. So that borrowing, Martin, that will tick the auditor's report. But again, if every client of the Perth Mint was to stand for these products, where they technically do not have all the metal because some of it has been borrowed, and some of it is not in their physical possession. So, and that obviously will cause issues around clients getting product when they want it.
Right. Very interesting. And so I guess you've got to ask the question, John, there are different business models, obviously. There are some entities who only focus on the physical stuff.
Yes.
There are others that have the combination of these things, right?
Yes.
And clearly the nature of those businesses are different.
Yes. I mean, so I'm happy to be completely transparent. So, the entity that I'm associated with, we do not provide any synthetic products to the market. So, we sell tangible bars and coins, and the philosophy comes from the ownership down, which is we don't believe in counterparty risk. Our view is you buy this gold and silver to eliminate counterparty risk, like compared to other assets. So if someone can't actually pick up a bar or a coin, well, we're not interested in actually taking people's money. So that's how we do things, and there are other organizations across the world that have a similar philosophy, but then obviously there are other entities who think that they can make money by providing other alternative vehicles, and again, these vehicles are based on they're based on lower fees for clients. They are based on less hassle for clients because they don't actually have to deal with physical metal, etc. But again, they do involve no ownership, and they do involve counterparty risk.
And actually, I think it's really good that you are raising this question of synthetics, right? Because I think many people just have not got their head around it, right? And it's important people understand the difference between the physical and the synthetic, right? And the pros and the cons and the risks.
Yes. So what I can say is, I over the last few years I've spoken to a whole host of Australians who, from people in the thousands of dollars all the way through to the millions of dollars, who have put money in a synthetic product, and they fully didn't understand the implications of what may happen during so and again, the risk of these synthetic products are not when things are okay. It's when things become acute. So and when could that happen? So for example, March of 2020, we saw the share market collapse because of the concerns over COVID-19, and we saw a surge of demand for physical gold and silver. Obviously, we've had a silver squeeze starting in terms of February, and that again has placed all sorts of pressure right throughout the global supply chain, and that's caused issues for certain products and certain providers. So anytime when you think about whether it's bail-in or whether it's these types of products, it's about at those moments of crisis, is your investment secure? Have you considered all the risks? And if you haven't considered all the risks, well, are you going to lose out, or are you going to be okay?
Yeah, and it's not necessarily just reading the small print in the contracts, right? You've actually got to stand back and think of it slightly more structurally in terms of the way things that actually work.
Indeed. Now I had a very good conversation in another show, Martin. I did a number of shows last week about these sort of issues, and so there's a channel in America called Liberty and Finance, where we spent about 11 minutes talking about these issues and the risks, and how does it fit in with the global sort of situation now with the silver squeeze. So Dunning & Kaiser from Liberty and Finance has given me permission to replay that. So I thought, why don't we just replay that, because I think I really hit the nail on the head of trying to explain some of these concepts.
You warned us I'm thinking it's about 8 or 9 months ago, we had a panel interview with you and Andy Schechtman together talking about the risks that people who think they are holding silver or think they're holding gold because they buy into the SLV or the GLD ETFs. They think, well, that's just a much more convenient way of actually participating in metal ownership. But you raised some serious concerns and really broke that out for us about the risks that there may not be really the ability to take possession of metals under those agreements, or even the assurance that the correct amount of metals are held under those. And you just mentioned earlier in this interview that there's actually been a prospectus change by SLV saying that they won't necessarily be able to keep up with keeping the physical silver ownership synced up underneath the fund. Andy Schechtman has talked about his analysis of the prospectus, saying that there's so many levels of lack of accountability and transparency that with the retail shareholder on the you could say they're at the bottom or they're on the top. But anyway, they're on the edge of that, have really no hope of getting any satisfactory explanation for if there is a deviation from what would be what you'd expect to happen if you were a physical owner of gold. So can you talk to us about new information that you're getting about whether holding these synthetic or pooled or non-allocated means of trying to participate in metals ownership is nothing like owning the real thing, and what the risks are that people may not be aware that they're being subjected to?
Sure. So on my website last year, I wrote an article about these type of products, and I said beware of synthetic gold and silver products. So, so here's the thing, Dunnigan. Just going back to basic microeconomics, when you have a price ceiling below equilibrium, what economics tells you is you've got excess demand versus supply. And you've got a market distortion. Now, how do they hide that distortion? Part of it is they don't talk about gold or silver. And basically, I mean, CNBC, for example, talk about Bitcoin, and they talk about particular stocks that the establishment want to offload, and they get retail investors to buy them, etc. But one is you don't bring any attention to gold or silver, and you can keep the demand down. The other thing you do is you provide products to the market which give the illusion of ownership or exposure, but you actually don't. And where as I've been researching this over the last few years and connecting with more Americans who are very clued into this, I mean, this was a point I actually read from Craig Hemke and his work about how these synthetic, and when I say synthetic, unallocated, pool allocated, these ETFs, they all give the illusion of ownership, but technically, what do you own? Now, we have two big players in Australia. For legal reasons, I won't say their name, but they are LBMA accredited. They have unallocated, pool allocated products. So I've had a number of Australians. So the bullion dealership I work for, as good as Gold Australia, we don't believe in synthetic. We sell the real stuff, or we sell nothing at all. So when I've talked to people across the country, and people say, well, because the reason why people buy this is because the margins are smaller. So people think, well, I can get exposure at a cheaper price.
More cost-efficient way to get more ounces of participation with a lower entry cost and fast transactions in and out, no shipping, no insuring, no storing.
Absolutely. Yeah. Absolutely. So when I've had people call me up and say, okay, I've got unallocated, and I've had some small clients, I've had clients who have owned tons of unallocated gold or silver at various institutions in Australia. And I've said to these guys, so what do you actually own? And so when you think about ownership, it's legal title. What is your legal property? And so when you, for example, buy a kilo of silver from As Good as Gold or from Miles Franklin, and you get it, that bar of silver is your physical legal property. You have legal title to that property. But when you buy unallocated, you don't technically own anything. What you've effectively bought is a promissory note from a counterparty that, as the price fluctuates, you will enjoy the benefit of that fluctuation. If you wish to convert from this synthetic to physical, you have to pay an additional fee, and we'll be able to come up with it. But in essence, you have bought a promissory note from a counterparty that, A, if the price goes ballistic, they're going to give you the requisite fiat currency dollars back. And two, if you do want to convert to physical, that they're going to have the requisite silver or gold to be able to borrow it for you, so that you actually have the physical. And I can tell you there is a very big scandal / problem in the Australian market. The Perth Mint has run dry of silver. So I was hearing direct reports from eyewitnesses in late February, people walking into the Perth Mint in Perth in Western Australia, and they were being told no silver for sale to the general public. Now, what I can tell is that starting at the beginning of March, to accredited, approved distributors for the Perth Mint, they cannot place an order on the Perth Mint for silver. So when I was told this by people in the industry, I said, well, for example, does the size of the order matter? So if you're a $10 million client versus a $1,000 client, if you have a big order, will that size of order give you priority in the queue? And I've been told it doesn't matter what size order you come up with. Since the beginning of March, Perth Mint cannot deliver. Now, they have some supply chain problems. I was given some insight into what that are. I can't go into more detail, but they are struggling to source enough silver to meet up with demand. But the big danger is, if you have unallocated at the Perth Mint and you wanted to convert to physical today, you can't do it. And that's the real counterparty risk. I mean, the irony of this is, Dunnigan, is you buy gold and silver because to eliminate counterparty risk. So, you think about stocks, you think about real estate, you think about financial instruments, you think about cash, like a cash in a bank. These are counterparty risks. Gold and silver, as the theory goes, there's no counterparty risk. Well,
unallocated, pool allocated, there is counterparty risk in that. And so I would say two things. One is there nothing substitute. There is no substitute to owning the actual physical gold and silver. So if you have a synthetic product, unallocated, pool allocated, and maybe they come up with different terminology in different countries, but these are the general terminology in Australia, you are much better off for your financial security to get physical. Now, when it comes to ETFs, when you buy an ETF, what have you actually bought? You have bought a unit in a trust. And we just said in this interview, and you just confirmed this, that with SLV and some of these other ones, they changed the legal documentation and they've said that the underlying assets of the trust don't match the shares. So you buy it on the premise that you've got access to, or you've got exposure to physical, and now they just said, well, that exposure the formula has been changed because we can't get enough physical. So again, huge amount of counterparty risk. So that's a really big problem that a lot of investors, particularly I've noticed in the Australian market, haven't really fully come to grips with. Well, what am I buying when I buy these synthetic products? But the other key point I want to make, Dunnigan, is that where, obviously when you look at the COMEX, if you're looking at where price is going and all this pressure in the physical market, I mean, there is some voices who are thinking, okay, we've got the COMEX on the edge of breaking. We need a big whale to come in and really sort of deal the final blow. So we need a Warren Buffett, we need an Elon Musk, we need a Samsung, we need an Apple. We need a big company with deep pockets who can really break the COMEX open by a huge amount of physical demand that they just can't match. Now, I would argue that just retail customers alone, if you have a synthetic product, unallocated, pool allocated ETF, if you take your money and you go and get physical, that happened worldwide, we would crack the COMEX today. I think there's enough demand out there. And I know that here in the Australian market, there are millions and millions of dollars in these synthetic products. If the synthetic was converted to physical, those institutions who sell synthetic to the market, they will struggle to deliver. And if somehow they were able to deliver, that means there's less silver to go around for other parts of the silver market. So less silver for the ETFs, less silver for London, less silver for COMEX. And the more we squeeze, the more pressure we can apply, and we can actually conquer this market manipulation that's been happening since 1974. So we obviously, when you think about populist movements, and I've sort of been a part of a populist movement here in Australia, fighting this $10,000 cash ban, and we led a grassroots movement, and it took us 16 months, but we beat the federal parliament and we stopped this law from coming into power. And obviously with your channel and other channels, there's a grassroots movement in terms of the establishment of the swamp, Wall Street, Washington, and obviously silver squeeze, Wall Street bets, Wall Street silver. This is all about populism, grassroots, individual Americans. And I think I listened to, I think you did a roundtable in the last couple of days with Rick Raw and Keith Neumeyer.
Correct.
And you said that some of your clients are saying, it's not about the money, it's about the cause. I want to fight the cause. So how do you fight the cause? The more physical silver, and it's got to be physical, it's got to be tangible, you've got to be able to hold it, or you've got to have it somewhere that you know it's actually there. The more physical that the individual investor takes, we can crack this market without the big fish. So I really believe that. But again, I just haven't, until I started writing these articles, because this was based on some of the personal experience I was seeing in the Australian market, I haven't seen a chorus of YouTube channels in the community talk about synthetic products and how they are actually diverting demand away from the physical, and these synthetic products are part of this international scheme that's allowing these prices to be suppressed.
Yeah, well, John, I think you were really on song then. Well done.
Thank you. Now, where I want to take the conversation now, Martin, is just to highlight in terms of, well, when we do talk about counterparty risk, what are the risks that we talk about? So obviously, one of the risks that you sort of alluded to earlier in the conversation was, well, what if they don't have 100% backing? What if everyone was to ask for their metal today? What would that mean? That would basically mean that certain people wouldn't be able to actually get in terms of their metal. the backing question, that's perhaps the most important fundamental question of do they have or don't they have it?
And presumably, John, if there was a significant demand, they would have to go out and buy from the market, and that could in itself move the price.
Yes. I mean, so one is backing, but you also make a very good point. If, for example, if Martin North was running offering a synthetic product, and you had $1 billion coming today, you would actually have to go buy that $1 billion worth of gold or silver to actually back that product. Now, it may be difficult to source. You may actually have an impact on the price. But the other thing is that from the time the funds hit your product versus when you actually can source the silver or the gold, the price may change, and so that it poses risks to you as the provider. So in those sort of situations where there is a mismatch between the amount of funds you have taken on versus the amount of silver or gold that you may actually have on hand, there is market risk, and those market risks they have to be hedged. And obviously, one of the issues for retail investors is that, well, who does the hedging? Is it you, Martin, as the provider? Is it a bank? Do you go to a third party to do the hedging? What sort of hedging strategy is used? Is the hedging effective? Is it not effective? Do you suffer losses if you've actually hedged wrongly? And if you have suffered losses, are those losses so significant that you can't pay back investors? So there's some of the critical, I think, questions around some of these risks. And again, touch wood, nothing so far in the Australian market hasn't gone wrong so far. But we're actually going to go through a very juicy case study that happened last year where overseas actually something did go wrong.
And part of this, John, is the question: how frequently do they mark to market? So do they identify the risks? Do they know the risks? Are they positioned appropriately if things move? Right, because it's when things move, potentially they get caught.
Yes. Now, look, before we talk about this case study, Martin, a couple of days ago, we had a really interesting conversation on the phone, and you were telling me about when it comes to hedging strategies, whether it's commodities or other financial products. You were talking to me about how banks have a black box, and sometimes it's hard, even for professionals, to understand how are these institutions hedging in terms of various positions. So maybe you want to elaborate that for the audience.
Yeah, well, I can talk a little bit about it. So I used to teach capital markets around the world, and one of the really interesting things that came up was always, how do you actually know what the risks that you are managing are, and how do you report them, right? And for a long time, the rules were pretty fuzzy, right? And they've become more and more clear now, and most of that's around what I mentioned earlier, mark to market. In other words, you have to actually, on a continuous, regular basis, know where you are, know where your exposures are, and know what that delta is, and know how to handle it, right? And in many cases, large organizations will effectively have this almost black box thing where all the transactions are coming in and out, right? And they're netting off against each other. And then the question is, what's the net position that you have, and how do you hedge that net position, right? Now, that is a very technical and complex piece of kit. There aren't many people in those organizations who actually understand how they work, and I would also suggest to you that not many of the auditors who are responsible for looking at these big organizations will have the expertise to really understand how this works. This is highly technical, highly specialist, and yet I know of organizations who've actually not got their black box working effectively, and they suddenly find that they've got a mismatch, right? And believe me, some of those mismatches can sometimes be quite large and can create significant grief when they try to actually deal with those open positions. They have to, in most countries, do it on a regular basis. In other countries, it's a little bit more fluid still, so it just depends where you are. But this concept of mark to market and the black box is pretty important to understand.
Yes, and you know what, Martin? As you were saying that, I remember a scene from the famous movie in terms of The Big Short, and there's a scene where I'm pretty sure one of the main characters is sitting down with Morgan Stanley and basically saying, well, how big are the losses for the bank? And what was revealed in that conversation was that they went short in terms of some of the triple B bonds, the subprime bonds, but they went long on the double A.
Yep.
and the bet went wrong, and the net position was a loss of $15 billion for the bank, which was catastrophic.
Yeah, absolutely. And that's the point, what people don't understand, that we're dealing with vast quantities of risk here and offsetting movements, right? And so if things are in balance, it's not too bad. But if things start going awry, then the gaps that can be created and the exposures that can be created are massive. And if you think about the quantum of derivatives that we've got in, around the globe at the moment, nobody quite knows how much there is. It's a big number, right? It doesn't take much for those things to start shifting and then creating huge sinkholes of effectively risk that people find it very hard to deal with.
Yes. Now, before we get onto the case study, Martin, one final point. There are people out there who have made a whole host of claims about these in terms of some of these products. Now, in the clip that with Dunning and Kaiser, I talked about SLV and basically saying they changed their legal documentation. So their commitment to the market of you bring in money, we'll back it up with silver. I mean that sort of changed. Now, so besides some of these ETFs, there are some people who do not think that even though there are claims of 100% backing, that backing is as presented to the market. And obviously we just talked about sort of leasing arrangement in terms of the Perth Mint. So when we've talked about market manipulation, gold and silver, and the one-to-many relationship, we have referred to this in the previous conversation, but some people have said that with leasing and rehypothecation and all this sort of shenanigans, you could have claims of anywhere up to 500 to 1,000 per ounce of gold or per ounce of silver. So again, very hard to know exactly what are all the deals, the arrangements, the counter arrangements, etc. But there are people who, while in the current environment there are assurances that everything is above board, there are people out there who think that that a lot of these arrangements between large institutions have created risks that are not clear to the general public.
And I guess on my simple mind, the further you're away from that physical silver or gold that you hold, right, the further you go away from it, it gets more fuzzy, the risks potentially get bigger, and the chances of something going wrong probably increases.
Indeed, and so let's talk about where something did go wrong. Now, in the case study, we're going to just highlight this wasn't necessarily happening in terms of the retail level. It actually was in the futures market. But so in the futures market, there's a concept of what they call exchange for physical. Exchange for physical is if you have a contract that says you are entitled to get some gold, for example. If people in New York don't want to deliver, they have the ability to send that contract across to London, and London is the largest market for gold and silver, and people in London they can deliver. Now, generally, there is no physical delivery with these contracts. Generally, what happens is the contracts are either rolled over or that they're settled in cash. Now, what happened in March of 2020 was because there was panic in terms of the financial markets with the stock market falling 35%. Novel idea, Martin. Someone said, no, look, this time around, I actually want the gold. And so there was a whole range of contracts, these exchange for physical contracts. They went to London and they said, well, because everyone's panicking, I actually want the gold now because I don't want fiat currency. I don't want financial instruments. I actually want physical gold. And so what happened was the counterparty in this case was HSBC. They didn't have any gold, and so now they were going to default on the contract. So they had to go. So in order to fulfill the obligations of the contract, they had to go out into the open market and buy the requisite amount of gold at that current price. And the price that they bought it at versus the price that was in the contract represented a loss of $200 million. And so there's an article by Bloomberg. So let's actually put that on the screen. And the article talks about how HSBC lost $200 million in a day. So how did that happen? Was there was a commitment. These contracts are effectively like, well, we have the gold. If you want it, we can give it to you. Well, someone one day asked for it, and HSBC didn't have it. And again, I mean, we think of banks as large entities with billions and billions of dollars, but I mean, the way it was presented to my mind, Martin, that $200 million loss in a day was a huge event for the bank, because you've got experience. I mean, in terms of quantity is $200 million in a day, is that a drop in the ocean, or is that is that a very big deal for a bank?
Oh, I think it's a big enough loss to note. I mean, there are bigger examples around, right? But it goes back to what I said. It can happen quickly, right?
Yes.
If things move, and people are then out of position, and then they try to cover it up. And I was involved with one organisation, I won't mention who basically spent about 9 months trying to cover up a bad position that they got, right? And the market just kept moving against them and against them and against them. And they ended up with literally billions of dollars of exposure that they couldn't deal with. And that created effectively a fracture in that particular organisation. So, these things can get big quickly, and it can create huge issues quickly.
So I mean, you've got me intrigued. So did the institution take the loss, or how was that position resolved?
The institution was disbanded and reconstituted.
Right. So because of this,
it was actually life-changing for that organisation.
Right. So there you go. So sometimes these positions can become so colossal that it actually threatens the financial viability of the
Correct.
institution itself.
Exactly.
If anyone would like to read my body of work and critique it, and I know there are people who have a slightly different point of view compared to me, I'm always happy to take criticism about what I've written. And part of what I've done since talking about the in terms of the household debt bubble back in 2016 is to publish all my work on my website free of charge. And I've said to people, well, I stand by my analysis. If you have an issue with it, challenge me, let's have a debate, and we can go through the issue. So I encourage people to, again, if you are involved in this market, gold or silver, if you have one of these products, or if you are looking at various options, it's definitely worth your time to actually understand the differences between owning something that you have legal title to versus something that is a synthetic product, and what are the risks and what are the insurances, and obviously everyone has to make those sort of assessments. But if anyone would like some assistance or would like to talk to me, feel free to email me. Let's pull my email up on the screen. Happy to chat about these various things and my views on them. Hopefully as this silver squeeze movement continues, as more people who and one of the things I find, Martin, I should say, is we've had a lot of people in the last couple of years come into the gold and silver market, particularly here in Australia, who have never owned gold or silver before. So you do have some very sophisticated people who have been doing this for a long time. You have a lot of people who have never done this before, and people. I mean, generally, people who get caught out are people who are new entrants to a market who sort of don't understand in terms of the terrain. And those things happen in real estate. Those happen in the share market, and it also happens in gold and silver as well.
Yeah, and just, John, to drive the point home, I know people who trade shares and use synthetic examples of shares, right? And they have exactly the same exposures, and they don't get it. They don't understand the difference between the underlying and some of these synthetic things. So it's really, really important for people to really understand what they're getting into.
Absolutely.
John, I appreciate your time today.
Thank you.
Martin North, John Adams, in the interest of the people. We'll see you next time.